Welcome to the Building a Financial Fortress podcast, helping you increase your financial knowledge. This is episode 16, recorded on May 7th, 2022. This podcast is for entertainment only and is not investing advice. Please do your own homework. So we'll get started with the market update as usual. Then we'll get into some Bitcoin news. And I thought this week I would talk about estate planning um, for Bitcoin. And again, this is something I've gone through recently, so others may have different experiences, but um, it's kind of a new area since digital assets are kind of a new thing. So, moving into the market update, this is the weekly Seeking Alpha update. The stock market finished the first week of May with modest losses that masked a turbulent performance that saw the Dow Jones average post both its best and worst days since 2020. The three major indexes started the week with three straight positive sessions, then plunged in a sharp sell-off after investors decided the Federal Reserve's implied policy tightening cycle ahead was still very hawkish, even as Chairman Jerome Powell took 75 basis point rate hikes off the table. Investors remain nervous about the Fed's ability to tighten financial conditions to combat inflation at 40-year highs without knocking the economy into a recession. The Dow Jones average lost only 0.2% for the week, but it was still the sixth straight declining week for the index, while the S&P 500 also fell 0.2%, and the tech-heavy Nasdaq Composite slumped 1.5%, closing nearly 25% below its record high from last November. So definitely an interesting week in the markets, and we'll see where things go next week. But definitely a wild time, and I don't really have any changes to how I've done my allocation. And I think next week will be the portfolio allocation update. So we'll check in there, but I haven't really made any big moves or anything like that. So moving on to Bitcoin news. This article here is from Fortune. This was looks like it was written a while ago, but it just popped up here recently, probably because it was updated. But Argentina's IMF bailout deal includes a wild clause that rips cryptocurrencies. Argentinian senators just approved a $45 billion bailout deal with the International Monetary Fund on Thursday that will help the country avoid an imminent default on its debts. But that's not the unusual part of the agreement. The deal, which was approved in a 56-13 vote, includes a wild provision that will force the government of President Alberto Fernandez to take a tough anti-cryptocurrency stance. The clause was included in a letter of intent signed by Economy Minister Martin Guzman and Central Bank President Miguel Pesce on March 3rd. It detailed Argentina's efforts to discourage the use of cryptocurrencies with a view to preventing money laundering, informality, and disintermediation in order to further safeguard financial stability. Interesting, this article was written in March, so it's actually almost a month and a half old. The deal still needs to be approved by the IMF's executive board, but if it goes through, Argentina will have secured a payment postponing grace period through 2026 and will immediately receive roughly $9.8 billion in the country's 22nd agreement with the fund. That's good news because Argentina was staring down a $2.8 billion payment due to the IMF and a total of $39 billion in debt payments through 2023. Let's see, and then Argentina's rising inflation rate hasn't only caused the country to seek financing from the IMF, it's also led to a surge in users for crypto firms in the nation as consumers look to protect their paychecks. Two of the top crypto exchanges in the country, Lemon Cash and Ripio, boast millions of active users and have recently expanded their offerings of crypto credit cards that offer cash back in Bitcoin. So in a country like Argentina, where you have very high rate of inflation, I think it says here, Argentina saw its annual inflation rate rise to a whopping 52.3% in February, and they're forecasting it'll be more than 60% in 2022 as global commodity inflation hits home. So when you have that high rate of inflation, people tend to want to put their money into things that are going to defend themselves against inflation. And so gold or silver or cryptocurrencies, Bitcoin in particular, are usually where people want to put their money, to get away from the local currency or foreign currency like dollars, probably mostly, and other strong foreign currencies. And so it's just kind of sad that the IMF, who's supposed to be helping this country with this bailout, comes in and basically wants them to put all these controls on cryptocurrencies and essentially um, uh, not allow people to use them freely. Um, let's see, it says this, it was detailed in a letter of intent. It detailed Argentina's efforts to discourage the use of cryptocurrencies with a view to preventing money laundering, informality, and disintermediation in order to further safeguard financial stability. So there's this big concern that somehow, cryptocurrencies are going to destabilize the system, but the reality is the system is already destabilized. So anyway, it's just interesting because I know that the IMF has been critical of El Salvador making Bitcoin legal tender, and that potentially jeopardizes El Salvador's ability to get support from the IMF. And I think last week also came out with uh, a statement critical of the Central African Republic for also recently declaring Bitcoin as legal tender. So it'll be interesting to see how this plays out. But clearly, the International Monetary Fund is not a fan of cryptocurrencies, and they will look to be um, putting up barriers. Seems like for a lot of these countries that actually need it probably more than they need more loans and more debt, um, which they seem to need more and more of. The next article is Fidelity to offer Bitcoin to your 401k. So it says Bitcoin is coming to your 401k. Fidelity Investments made history this week when it announced that it would give participants in employer-sponsored 401k plans options to invest in Bitcoin. Fidelity is the largest retirement plan provider in the US, and it becomes the first to add Bitcoin as a 401k plan investment option. Roughly 23,000 companies use Fidelity to administer their retirement plans, and Fidelity currently has more than 11 trillion in assets under administration. Cryptocurrency enthusiasts celebrated the move, which will be implemented in mid-2022. Some regulators and wealth management professionals, however, expressed skepticism that cryptocurrencies should play any role at all in retirement investing. That's an interesting one. Fidelity will allow retirement investors to allocate up to a maximum of 20% of their nest eggs to Bitcoin. The company also said that individual fiduciaries may establish their own employee contribution limits and allocation maximums. But before you get too excited, understand that Bitcoin won't be showing up on your 401k plan's investment menu immediately. Fidelity is still building its digital asset platform, which should become available in plans later this year. Beyond that, employers will have to approve crypto investments inside the plans they provide to their workforce, and because of their fiduciary duty, placing the needs of plan participants above all else, companies may be reluctant to provide immediate access. Many will likely take a wait and see attitude before making a move to offer crypto as part of their retirement plans. There's no question that interest in Bitcoin and cryptocurrencies has exploded in recent years. A 2021 Fidelity Digital Asset Study found that 30% of U.S. institutional investors said they wanted an investment product containing digital assets. The company also estimates that roughly 80 million American investors have already invested in digital currencies. Demand is very high for crypto exposure in retirement accounts since people are typically able to better withstand volatility in accounts they deem to be tax-advantaged long-term investments, said Mike Burrows, CFA head portfolio manager for the Fortis Digital Asset Fund. However, Bitcoin's track record of extreme volatility and its lack of regulatory oversight has some experts urging employers and investors to proceed with caution. In March, the Labor Department advised 401k fiduciaries to exercise extreme care before they consider adding a cryptocurrency option to a 401k plan's investment menu. The Employee Retirement Income Security Act of 1974, or ERISA, requires retirement plan fiduciaries, including trustees, administrators, and investment committees, to diversify the plan's investments in order to minimize the risk of large losses. The Labor Department isn't the only U.S. regulator to issue warnings for investors about cryptocurrencies. The U.S. Securities and Exchange Commission has also cited concerns over fraud, manipulation, and investor safety in rejecting several applications to approve Bitcoin spot exchange traded funds. So we already know about the SEC's position. The Department of Labor, their concern seems to be, well, I guess I just don't understand it, because diversification, I mean, allocating a portion of your portfolio to Bitcoin is diversification. I mean, it's not any different than having 20% of your portfolio in, let's say, Tesla uh, or the SPY ETF or the QQQ ETF. In fact, like I've talked about before, I think a lot of stocks have been even more volatile than Bitcoin has recently. Bonds have actually had the worst start to a year ever. And so if you were invested in a bond fund, you probably took like a 10% loss in the first quarter, which I guess isn't as bad as taking a 20 or 30% loss on a stock fund, but still, I don't think I agree with this position that they're taking here, that they think it actually increases your risk. If anything, it reduces your risk. The United States Department of Labor, which regulates company-sponsored retirement plans, said the Fidelities could threaten the retirement security of Americans. We have grave concerns with what Fidelity has done, Ali Kawar, acting assistant secretary of the Employee Benefit Security Administration, told the Wall Street Journal. The regulator is discussing its concerns with Fidelity, especially the 20% threshold. Charles Field, managing partner of the San Diego office of Sanford Heisler Sharp and chair of the firm's financial services group, says the SEC and Labor Department warnings could provide support to any claimants in potential future litigation against companies and their fiduciaries. Bitcoin is still experiencing growing pains, and with the next market upheaval will come claims that fiduciaries who approve Bitcoin breach their fiduciary duty of prudence, Field says. At this stage, there may not be enough disclosure out there that would protect employers from such claims. Employers who offer Bitcoin in their 401k plans do so at their own peril. In addition to the potential legal risks to employers, it's unclear just how appropriate of a retirement investment Bitcoin is. Bitcoin has been a tremendous investing success story up to this point, but many retirement investors are hoping to build wealth over several decades. Then it goes on to say that Bitcoin has a short history and uncertain value. The first Bitcoin transaction in history was completed just 13 years ago, so it doesn't have the long-term track record of success that stocks and bonds do. Bitcoin is also prone to extreme periods of volatility that retirement investors may wish to avoid, such as its roughly 80% crash in late 2017 and 2018. Owen Murray, Director of Investments for Horizon Wealth Advisors, says it is still extremely difficult to determine the true values of Bitcoin and other cryptocurrencies from a fundamental perspective. Bitcoin does not represent ownership of physical assets or intellectual property. It does not generate cash flow. It does not pay interest rates or dividends, meaning its price is tied exclusively to investor sentiment and demand. I think it is reckless for firms like Fidelity to make crypto available to retirement plans, Murray says. It appears to be opportunism at its worst, and the consequences could be severe for those who jump in without really understanding the risks. Jamie Cox, managing partner at Harris Financial Group, says Bitcoin is a fiduciary lawsuit waiting to happen for retirement plan sponsors, and Fidelity's decision could put the firm under heavy regulatory scrutiny for the time being. Adding speculative asset classes to 401ks isn't in keeping with the intent of qualified retirement plans. Wow. So let's break this down. First of all, you don't have to invest in Bitcoin if you don't want to. All this is doing is giving you the option. And that's Fidelity's giving your employer the option. Your employer has to decide whether or not they want to allow it. And then they could also limit it too. And they could say, oh, no, you can only have 5% or 2% or 10%. I mean, I think when Morgan Stanley first allowed their clients to invest in Bitcoin, they limited it to only the highest of the high net worth clients, and they limited it to 2%. So whatever the limit is that, whether it's the Fidelity limit or, the employer limit, it's still your choice. And most people that invest in Bitcoin actually understand it. This article seems to say that people will just throw their money into it without even understanding it, and I think that's false. And then in terms of the value proposition is Bitcoin is a store of value. It is immutable. It's an immutable ledger. It's absolutely scarce. And it's a commodity. And in many respects, I guess if you want to try to compare it to something, it's like gold. And in fact, my 401k plan doesn't allow me to allocate to precious metals or gold. So, Bitcoin to me would be just another of those types of options. I don't think it would be reckless. I think it's reckless for retirement plans not to offer Bitcoin as an alternative, because what are your alternatives now? Bonds? Bonds are losing money hand over fist. And as interest rates rise, they're going to get destroyed. They're getting destroyed. And if interest rates go back down again, well, maybe they'll rally for a little bit. But what are rates going to be? 1%? 2%? Is inflation going to be 1 or 2%? Probably not. Not in the long run. Not for the next 10 years. So it's, I think, reckless not to offer more options to 401k investors, like alternative assets, like gold, like silver, like Bitcoin. And people are savvy. They will figure it out. They will understand it. And if they want to choose to invest in it, they should be allowed to. I don't know about the fiduciary lawsuit thing. I think that that just sounds like, all of this really sounds like scaremongering, trying to get people, companies, to be afraid to allow their employees to invest in alternative assets, which to me, as part of a normal diversification strategy, you should be able to do. I mean, you shouldn't just be able to invest in, okay, here's three bond funds. Oh, here's cash. Here's a bunch of stock funds. Oh, and here's real estate. That's okay. We have a real estate fund. That's it. That's that's typically what a lot of 401ks offer. Is just or oh, better yet, just invest in one of these life cycle funds, so it'll just automatically rebalance closer you get to retirement age. That's not investing. That's not diversification. So I couldn't disagree more with what this is saying. Will other retirement plan providers follow suit? So, on a positive note, the good news for Bitcoin investors and supporters is that Fidelity's willingness to embrace cryptocurrency in its retirement plan offerings helps to legitimize cryptocurrency as a long-term investment further and raise its profile as an emerging asset class. Joe Sweeney, managing partner at Cornerstone Wealth, says, Fidelity's stamp of approval holds a lot of value in the world of finance. The goal of a 401k is to enable participants to save for secure retirement. Sweeney says, that said, yes, the imprimatur of Fidelity will absolutely raise the standing of cryptocurrency among some significant number of Americans. Sweeney says Fidelity's decision will put pressure on other major retirement plan providers such as Vanguard, Charles Schwab, to offer Bitcoin options for retirement investors as well. However, Cox says other providers may not necessarily be too eager to follow Fidelity's lead. I think most will take the you first approach to see if Fidelity lands itself in the regulatory and litigation abyss before adding crypto to their plan options. Moving on. Last piece of Bitcoin news for the week. This was 2 days ago. This is from Bitcoin.com. I'm sorry, the last article was in Forbes. California Governor Newsom signs executive order on crypto, blockchain, and Web3. The governor of the U.S. state of California, Gavin Newsom, signed an executive order Wednesday to create a transparent and consistent business environment for companies operating in blockchain, including crypto assets and related financial technologies, according to a notice published by the Office of the Governor. The notice states, quote, California becomes the first state in the nation to begin creating a comprehensive and harmonized framework for responsible Web3 technology to thrive. Under Governor Newsom's executive order, the state will also assess how to deploy blockchain technology for state and public institutions and build research and workforce development pathways to prepare Californians for success in this industry. The notice adds that the executive order aims to create a pipeline of talent for the emerging industry and utilize the technology for public good. Governor Newsom commented, California is a global hub of innovation, and we're setting up the state for success with this emerging technology. He opined, too often government lags behind technological advancements, so we're getting ahead of the curve on this, laying the foundation to allow for consumers and business to thrive. California's executive order builds on President Joe Biden's executive order on the regulation of crypto assets, which he signed in March. So, not sure how to feel about this, but it certainly doesn't hurt that the governor is favorable to the cryptocurrency industry, which would include Bitcoin. I think that certainly bodes well as opposed to banning it or trying to overregulate it or something like that. So I would probably say overall that's probably bullish for Bitcoin, considering the size of the state of California and and the fact that also Silicon Valley has been a big driver of innovation of the technology industry. So it seems like many states are competing now to attract this Web3 or cryptocurrency industry. So not a bad thing at all. Okay, and Now we'll get into a little bit into talking about Bitcoin estate planning. So now I am not an attorney and I don't pretend to be one. All I can really work off of is my own experience in putting together my own estate plan. So I will say that first and foremost, make sure that you hire a really good estate attorney. Um, you will spend some money, but the money is truly well spent to have a plan, um, to know what's going to happen, you know, uh, when you're no longer here. And it's not a question of if, right? It's just a question of when. So hopefully you live a long life and you can enjoy um, all the things that life has to offer. But it does make sense, and it's important to prepare, um, you know, um, your estate plan for your loved ones, for your kids and grandkids, and so on and so forth. So now it may differ. Individuals may differ. Different states may have different things, but for mine in particular, there was a revocable living trust, and so what that is essentially it's a container that you basically deposit all your assets into, and you can pretty much do what you want while you're alive, and then when you pass away, the trust will come to life and will take care of how those assets are supposed to be distributed when you're no longer here. Part of that is a durable power of attorney, which is really gives someone else other than you the ability to make decisions in your absence. If you're unable to function, maybe you're alive, but you're not able to make your own decisions or whatever. So you'll have somebody that'll be able to do that for you, and then that advanced healthcare directive, which is really how you want your health care to be managed if you can't speak for yourself. Um, and then, of course, a will, for the personal items and things and how you want those distributed. So the revocable living trust is needs to be funded, which means that so in a simple case, let's say you have a stock brokerage account in your own name. What you would do is you would set up a new account in the name of the trust, and then you would the revocable trust, and then you would move all the assets from the personal account into the trust account, and then you would close out the old account. And the same would go for like your home. So you would basically record a deed transferring your title from you and your wife into the name of the trust. And you might have to get permission from your lender, but usually it's not a big deal because it's still you. And then it kind of goes that way for all your other investment accounts and things like that. So pretty straightforward for normal types of investment accounts and investments. Um, but digital assets are kind of unique. And so when I asked my attorney, hey, what do I do? I've got this Bitcoin, and I want to make sure kids get it. He did a little research and he came up with basically just a simple letter, um, a letter of instruction. So basically, it's addressed to the successor trustee of the trust. Um, I basically filled it out and then I signed it and sent the original to my attorney, and I kept a copy in my safe. And it basically covers whatever digital assets you have. You may have NFTs, you may have other cryptocurrencies, you may have Bitcoin. So in that letter, it basically, first of all, explicitly, says that the Bitcoin that's in the wallets, the cold storage wallets, are included in the trust. Um, and to keep things simple, I just said just handle it the same as all the other assets in the trust. In other words, the way the trust is written is that all the assets sort of get pooled and then they get divided equally amongst the kids. That's essentially how it works. But you may have different things. Like you may say, well, I want to donate some money to this cause, and then after that distribute it to the kids or whatever. Um, so but just keeping it simple, it goes equally to the kids, and so basically the trust you know will take everything, including the digital assets, and handle everything the same way. And then the letter also references kind of where where to find things. I didn't really want to put the private keys in the letter, so what I did is I said, that there's a lockbox. So, there's a bank safe deposit box that has, there's two actually. One has the key phrase and the passcode in it, and then a different box at a different bank has the hardware wallet. And so, the letter will say, hey, look, this is where the safe deposit box keys are. You go to the bank, you open those boxes. There's other stuff in there too that'll need to get distributed to the kids, but that's where you'll find what you need. And then once you have the hardware wallet and the passphrase, then you should be able to access the wallet and then move the coins to the beneficiaries. Uh, So, I didn't want to put too much in the letter, but I did want to put enough in the letter so that, you knew where to go and what to do with it. You can also put specific instructions in there to the trustee, like, I don't want you to sell any of the Bitcoin unless you have to pay estate taxes. So sell other stuff first before you do that, and so on and so forth. So it seems to work pretty well. It does. That letter would need to be updated, of course, if you added an additional account or an additional hardware wallet. But that's the general gist of how I was advised to do it and what I ended up doing. I did learn about another way that you can do estate planning with your coin, with your Bitcoin, and that would be setting up a non-custodial multi-sig wallet. So you basically have three keys. So you control two keys, which two hardware wallets, and then the third one's controlled by the custodian or by the company. Um, and so you can't access the coins without two out of the three keys. So the company can't by themselves access your Bitcoin. You could because you have two out of the three keys. And so the idea would be maybe you give one key to the attorney, and then you keep one, and then the company has one. And if you pass away, the key that the attorney has can provide it to your trustee, and then they can, using the key that the company has, access the coins and distribute them that way. So um, there's companies like Unchained Capital. I'm sure there's other ones out there that have multi-sig setups. So that I thought was kind of interesting, and that one could be a little bit more, I guess, a little easier to administer. Although I kind of like having total control of the keys, but um, but multi-sig also is a little bit more secure because you have to have two keys in order to access the coins. You can't just access it with one key. So I guess if somebody were to steal your passcode, they would be able to take all of your coins versus If they stole your passcode, they would still need the other key in order to access the multi-sig wallet. So it's just a little bit more complicated to set up, and probably you need to be a little bit more of an advanced user for that. But certainly would make sense, to consider that too as part of your digital asset estate plan. So anyway, but that's what I wanted to share for this week. So thanks for listening to the podcast. If you enjoyed the show, please like and leave a comment. And don't forget to subscribe on whatever your favorite podcast app is so you don't miss an episode. You can follow my Substack at bitcoinfortress.substack.com. I usually write about the topic of the week in there and add some additional color so you can get some more details from that. And you can also follow me on Twitter. It's at Nick, N-I-C-K, Reichert, R-E-I-C-H-E-R-T. So I will talk to you next week. Bye-bye.